So you want to start investing.
But are you confident that you have the necessary expertise?
Did you know that most retail investors actually lose money when investing?
Yes, it's estimated that around 80% of retail traders actually lose money when they're investing.
Now, I wonder why would that be?
Maybe it's because they don't take the time to prepare, to increase their knowledge before actually starting to trade.
Always remember, when it comes to investing, you can never know too little. Always aim to learn more each day.
There are no guarantees, but you can shift the odds in your favor by following some simple rules.
And that is what we'll be covering in today's video.
So stay with us till the very end to learn what are some of the best rules to follow when it comes to investing. Do thorough research.
Regardless of where you want to invest your money, be it stocks, commodities, forex, crypto, the first step is to do thorough research.
Look at the macro trend, the high-level picture. Is the company performing well? Look at their balance sheet, income, and cash flow statements.
Evaluate if the business has growth potential in the future and if any global or national factors can affect the company's revenue or image.
If you want to be a long-term investor, it's critical that you know the market you are in order to make rational decisions.
If the overall trend is bullish, and yes, there may be some small corrections along the way, but in the long run, you should expect the asset price to grow.
Don't invest more than you can lose.
How many times have you heard this in the news?
People losing their cars or houses because they sold them in order to make an investment,
only to lose all of their money by making a bad investment decision. You must avoid this.
Set up a budget. It's crucial. How much money can you afford to lose?
When you want to invest in something, always remember, you can lose all or most of the money.
And in order to avoid this, follow rule number 3, which is
use a stop loss. This is one of the best ways to minimize your losses.
Yes, some investments will not go your way, regardless of how much thought process was put into it.
And there can always be what we call black swan events, such as the crash back in March last year, where only a very few select number of people knew that there was going to be a massive stock market crash.
Retail investors, you and I, will always play with a disadvantage.
And yes, sometimes you can be so unlucky and buy an asset just before a big stock market crash.
When investing, set up the proper stop losses in case your investment goes against you, so you can limit the impact on your portfolio.
A recommended strategy is no open position should generate a loss of more than 5% of your overall portfolio.
As we said, you cannot be right all the time. It's impossible.
A good investor will tell you that you only need to be right 60% of the time in order to make money.
It may sound like a low percentage, but remember that most retail traders can't even achieve this.
Never beat emotion.
Money is one of those things that get people really emotional.
Just think about it. How did you feel when you win some money?
Regardless of the amount, that feeling of winning will always be a highlight.
When it comes to losing money, things get worse. People become even more emotional and start panicking at the thought or sight of them losing money.
It will happen. You will open a position and think it may be the best one yet,
only to see that in a short while, things have gone exactly the other way around.
Yes, it's counterintuitive to our human nature, but leave your emotions out of it.
Don't base your investments on emotion. Avoid the scenario where you lost some money and start investing aggressively just to try to make that money back quickly.
There are no guarantees. Just because you had some bad luck, it doesn't mean that your next investment will be the big win.
You've heard it before, but especially when it comes to investing, patience is a virtue.
Be calculated, patient, and disciplined. Wait for the opportune moment to invest and do not let your emotions get the better of you.
The last golden rule to follow is what we consider to be one of the most important ones out there.
The trend is your friend.
But remember, the trend is your friend only until it ends.
This is a very common saying among investors.
Stay on the side of the market's momentum. If the overall macro trend is bullish, stay bullish.
You are more likely to make money by going along with the market sentiment,
not by betting against it, like trying to buy into a bear market
or trying to sell in a bull market. Both of these decisions are quite risky.
Remember that there will always be corrections, both to the upside and to the downside.
For retail investors, it's crucial to follow the market's overall sentiment.
However, you need to understand when things become too overheated by staying informed on a daily basis.
When your asset has reached your price target, it may be a very opportune moment to take some of your gains off the table.
Don't get greedy. It's almost impossible to sell the very top of the market. Cash in your wins and wait for the next opportunity.
That's it for today's course. We hope that the information we shared will help you become more profitable when trading.
Thanks for watching, and we'll see you in the next video where we talk about the candlestick graph. All the best!
Hello and welcome to the InvestAbros Academy.
Today, we will discuss the first thing you see when you log into a trading platform or when you think about the stock market.
And that is the most used trading indicator called the candle or candlestick chart.
If you like this video, don't forget to share it with your friends. Hit the like button for the YouTube algorithm.
And why not subscribe and hit the bell notification button? It's free and you'll be updated when we post a new video.
Remember, this video is just the first one in a series of free technical analysis tutorials we plan on bringing to you.
We know that many of the terms used may seem complicated. Some would say that they were specifically designed to be difficult for everyone to understand, but we promise to use a language that is user-friendly.
Some small bit of history behind this candlestick graph. It was invented by a Japanese rice merchant named Homa Monehisha almost 300 years ago.
It's important to note that even back then, he discovered that some price patterns were repeating themselves.
As we said, you've certainly seen these candle-like graphs, but what do they really represent and why some of them are red and some of them are green?
Well, you can think of a candlestick as a representation of the price of an asset in a given period of time.
And yet, why are some of the candles red and some are green? Well, it's simple. A green candle indicates that the price of an asset has increased,
while a red candle indicates that the price has decreased in the given time frame. So as the price moves up or down, so will the candle indicate the same change.
As we mentioned, it's an indication of price over time.
Okay, and yet you may be wondering what we mean by this time frame. Quite simply, any candle can be a reference of time of your choice when looking at a graph.
A candle can be a minute, 1 hour, or multiple hours, even a week or a month. It all depends on what you wish to see when you're trading and how detailed you want to see the price fluctuations.
We'll also cover why it's important to look at a candlestick chart over different time frames in a future video.
Let's now analyze in more detail what a candle entails, and let's take the example of this candle. As you can see, it's made up of several elements.
The thickest or colored part is called the candle body. This is the price area where our asset was generally traded for the longest period during the time interval.
The thinner part, called a wick or shadow, represents prices where the asset was traded at a certain point during the time reference, and it's what we call minimum or maximum price.
And yet, how can we read this candle? What does it want to tell us? Let's start with a green candle to see exactly.
As we said, a green candle indicates that the price of the asset has increased. More specifically, when a new hour started, the price of the asset was here, and during the interval, the price fluctuated up and down.
As you can see in our example, the price fluctuated, even went lower than the initial price, but it went up, and at the end of the time interval, the price closed here.
In the case of the red candle, the initial price was here, and during the time interval, the price went up, but then fell, and at the end of the time interval, the price closed below the starting price.
As a general rule, the closing price for each time interval will be the opening price for the next time interval. This may differ for higher time frame candles due to the CME gap.
Another thing to note is that there are so-called small candles, which usually indicate a period of consolidation with low volatility,
and large candles, which indicate a large volume of buys or sells, usually as a result of a rumor or news that impact the market.
These candlestick charts are fundamental to understanding the price behavior of an asset in order to figure out whether we are in an upward trend or a downward trend.
Therefore, they can indicate what position we should take in the market.
It's a basic thing, but don't forget that you can trade or make money regardless of the movements in the market.
For us, it's important to correctly anticipate the next movements in the market in order to make profits.
That's it for today. In our next videos, we will discuss the importance of identifying candlestick chart patterns in order to anticipate future price movements.
As we mentioned, these graphs were invented about 300 years ago, but the price patterns we see in the market now were visible even back then.
This indicates that we can anticipate, with some degree of certainty, what the next price move will be.
That's it for today's course. We look forward to seeing you in our next video. All the best! Hello everyone and welcome to a new video brought by the InvestaBros Academy.
As we promised, in today's video, we will discuss the importance of identifying different types of candlestick patterns in the market.
So we will see why it's important to recognize these patterns in order to anticipate future price movements by reviewing some examples.
And if you somehow missed the previous videos on what a trading candle is, we recommend that you start from there as to not lose any vital information.
And if you like this video and find the information useful, please subscribe to our channel
and ring the notification bell so you can stay up to date with our content. As the price of an asset fluctuates in the market, you will start seeing several types of candlestick patterns forming.
These movements may seem random to someone who is not experienced, but if you take the time to learn, you will start to understand the logic behind them.
Today, our analysis on candle chart movements revolves around the technical aspect of price evolution.
But always keep in mind that there are other factors which can influence the price. Rumors or news in the market, regional or global events, price manipulation and many others.
These factors will influence the asset's price and many times will override the technical aspect of the asset's price, especially in the short term.
Now, before we start, we want to share with you two terms used very often when it comes to trading: bullish and bearish.
Bullish means that investors have confidence in the market. The sentiment is optimistic and they anticipate a positive trend, meaning that the price of the asset will increase.
On the other hand, a bearish trend means the exact opposite. Market sentiment is negative and investors anticipate a negative trend that the price of an asset will decrease.
If you want to learn more about these two terms, bullish, bearish trends, and many others,
you can do so by accessing our website, linked in the description below.
Now, on to why it's important to understand different types of candlestick patterns.
Remember what we said in our previous video. It's important to look at the macro trend.
And also, a candle can represent any different time frames,
like an hour, a day, or a week. Well, let's correlate these two through candle pattern.
Certain types of candles can indicate a future bullish or bearish momentum, a breakout or a breakdown of a trend.
Depending on the time frame we use, candles will likely have more impact. For instance, an overall daily bullish trend will override a smaller 1-hour bearish trend.
That is simply because the time reference is higher. The impact from 1 day of trading will always be higher than that from 1 hour of trading.
Remember, there can always be small corrections, price decrease in an overall bullish trend and price increase in an overall bearish trend.
But enough with the theory. Let's see some examples of candlestick patterns.
The first pattern we have here is called the hammer pattern.
Let's assume this is a daily candle. As you can see, the price was quite volatile, but we ended up closing the day in an uptrend.
The long wick to the downside shows that there was indeed some selling pressure, meaning that the price went down, but this drop was quickly bought back up.
Which means that there is demand in the market for our asset and that the buyers are still in control of the price.
In order for this candle to be considered a valid hammer pattern, the wick of the candle must be more than 2 times longer than the body of the candle.
The body of the candle can be either red or green. And yes, the green candle indicates a stronger bullish trend.
Hammers are most effective when they are preceded by at least 3 or more declining candles. A declining candle is one which closes lower than the close of the candle before it.
Ideally, this confirmation candle shows strong buying pressure.
Candlestick traders will typically look to enter long positions or exit short positions during or after the confirmation candle.
For those taking new long position, a stop loss can be placed below the low of the hammer's shadow.
To conclude, the hammer candle is usually bullish and will likely indicate a future price increase.
Look for such candles in past price movements and see if this bullish trend was respected afterwards. Doji candle pattern.
The second type of candle that we want to show you is the so-called doji candle.
The first thing you'll notice is the body of the candle. It's almost non-existent, which means that the opening and closing prices are almost identical.
Also, as you can see, the wicks of the candle are long and in both directions.
This means that there was both buying and selling pressure in the market.
A doji candle is generally associated with indecision in the market.
This means that buyers and sellers are both insecure with what the correct price of the asset should be.
This candle type can indicate a change in the trend or a longer period of price consolidation.
Therefore, this type of candle can appear at the point of minimum, maximum, or even in the middle of a trend.
For those who trade, this candle is an important signal because this candle, corroborated with other indicators that we will analyze in future videos, may indicate a trend shift. The third type of candle we will review is the falling star.
It's pretty obvious what the name entails, right? This candle indicates a bearish or a future downward trend in the price.
As you can see, the body of the candle is very small. The opening and closing prices are very close to each other.
This candle pattern can be green and red. Obviously, if the candle closes red, the downward trend is even more pronounced.
For this pattern to be valid, the wick of the candle must be at least 2 times longer than the body of the candle.
Also, this candle must be preceded by an uptrend. The candlestick will usually indicate the end of this uptrend and a possible future price drop.
But how can we tell this just from a simple candle? Well, looking at the wick of the candle, you can see that the price was higher, but dropped close to or below the initial opening price.
This indicates a higher selling pressure. The higher price could no longer be supported by buyers who probably started closing their positions to take profits.
Another thing to note is that there is no wick at the bottom of the candle. This indicates that the closing price is also the minimum in the time reference.
To conclude, the falling star candle pattern usually indicates the start of a downtrend. So try to identify such a pattern in the market to see if the downtrend was respected.
And that's it for today's course. We look forward to see you in the next video where we will discuss more types of candles.
And if you like the video, you know what to do.
All the best! Hello everyone and welcome back to a new video brought to you by the Investabros Academy.
In today's video, we will continue to delve deeper in understanding different types of candlestick patterns.
And if you somehow missed our previous videos, we recommend that you watch them so you won't lose any essential information.
And if you like the video, don't forget to share, like and subscribe so we can reach out and teach more and more people.
And also don't forget to hit the bell notification button so you will know when we post a new video. So without further ado, let's go straight to it and see 4 types of candlestick patterns.
The first type of candle pattern we'll review is the inverted hammer.
The inverted hammer candle pattern forms in a downtrend and represents a likely trend reversal or a point of support.
You can view this candle similarly to the hammer pattern, except this one has a longer upper wick.
This indicates a strong buying pressure after the opening price, followed by considerable selling pressure,
which however wasn't enough to bring the price down below its opening value.
In order for this candle pattern to be valid, bullish confirmation is required.
And that can come in the form of a long, hollow candle accompanied by a large volume of trading.
So how is an inverted hammer candlestick formed?
Well, it's formed when bullish traders start to gain confidence.
The top part of the wick is formed when bulls push the price up as much as they can,
while the lower part of the wick is caused by bears or short sellers trying to push down the price.
However, the bullish trend is too strong and the market settles at a higher price.
So what does an inverted hammer tell traders?
It tells traders that buyers are putting pressure on the market, warning that there could be a price reversal following a bearish trend.
It's important to remember that the inverted hammer candlestick shouldn't be viewed just on its own. Look for other indicators that will support the trend change, such as increased volume of trading. The second type of candle pattern we'll review is the hanging man.
Its name is correlated to the shape of the candle, an unfortunate one maybe, but this candle can signal a strong potential reversal in an uptrend.
Look for this candle on a daily time frame, and remember, to sell or to buy an asset only based on a hanging man's pattern is a risky proposition.
Many traders believe it's a key piece of evidence that market sentiment is beginning to turn. The strength in an uptrend simply isn't there anymore, so it may be an opportune moment to look to sell the asset.
So when does the hanging man pattern occur?
It occurs when two criteria are met. Firstly, the asset has been in an uptrend.
And second, the candle needs to have a small body, a long lower shadow, and little to no upper shadow.
So how do we read this candle pattern?
Remember, this pattern forms in an uptrend, and it indicates that buyers are losing their strength.
While demand has been pushing the stock price higher, on this day there was significant selling pressure.
While buyers may have managed to bring the price back to the opening price, the sell-off is an indication that a growing number of investors think that the price has peaked.
In the Encyclopedia of Candlestick Charts, a book which we highly recommend, Thomas Bulkowski suggests that the longer the lower shadow, the more meaningful the pattern becomes.
You need to also look for volume, an indicator which we will review in a future video. Of the many candlesticks analyzed by the author, those with high trading volume were better indicators of the price moving lower than candles with low volume.
Another distinguishing feature is the fact that a confirmation candle needs to appear a day after the hanging man appears.
That may come in the form of a gap lower, or the price simply moving down the next day to a lower close than the hanging man's close.
According to Bulkowski's studies, this pattern predicts a further price reversal up to 70% of the time.
It's also worth noting that the color of the hanging man's body isn't of concern. All that matters is that the real body is relatively small compared with the lower shadow.
The bottom line is, on its own, the hanging man candle pattern is only a mild predictor of price reversal.
You need to look for this pattern in tandem with other specific characteristics. It will become a much better indicator.
Look for increased volume, a sell-off the next day, a longer lower shadow, and the pattern becomes much more reliable.
The third type of candlestick pattern we review is the gravestone doji.
A gravestone doji is a bearish reversal candlestick pattern that is formed when the open, low, and closing prices are all close to each other and the candle has a long upper wick.
This long upper wick suggests that the bullish momentum in the beginning was overcome by sellers by the end of the trading session, which often comes just before a longer bearish downtrend.
A gravestone pattern can be used as a sign to take profits on a bullish position or to enter a bearish trade.
So what does a gravestone doji tell us?
This pattern implies that the bearish reversal is coming.
While the open, low, and closing prices don't have to be equal for the pattern to be valid, there should be only a relatively small lower wick.
Otherwise, the pattern could be viewed as an inverted hammer, a shooting star, or a spinning top.
The market tells us that the bulls are attempting to push the price to newer highs, but the bears manage to push down the price near to the open by the end of the time frame.
The long upper wick simply represents that the bulls are losing momentum.
While the gravestone doji can also be found at the end of a downtrend, it's much more common for it to be found at the end of an uptrend.
Although it's a popular candle among traders, it can suffer from the same reliability issues as other candle patterns if it is not accompanied by other relevant indicators.
Look for a trend reversal confirmation following a gravestone doji candle. As with other candles, confirmation can come the following day with a long candle in the supporting direction.
As a trader, look to exit long positions or initiate short position after identifying a gravestone doji pattern and correlating it with other indicators such as increased volume of trading. The last type of candlestick pattern we will discuss is the dragonfly doji.
So what is a dragonfly doji?
It's a type of candlestick pattern that can signal a potential reversal in price to the upside or downside depending on past price action.
It's formed when the asset's max, open, and close prices are all the same. The long lower wick suggests that there was aggressive selling, but the price closed near the open, and it shows that the buyers are able to absorb the selling pressure and push the price back up.
Following a downtrend, the dragonfly candlestick may signal a price increase. Following an uptrend, it shows more selling is entering the market and the price decrease may be coming.
In both cases, traders typically wait for the confirmation candle before acting on the dragonfly doji.
So what does the Dragonfly Doji tell you?
While the Dragonfly Doji pattern doesn't occur frequently, when it does, it's a warning sign that the trend may change direction.
Following a price advance, the Dragonfly's long lower wick shows that sellers were able to take control for a time. While the price ended up closing unchanged, the increase in selling pressure during the period is a warning sign.
The bearish Dragonfly needs confirmation of the reversal. The candle following it must drop and close below the close of the Dragonfly candle.
If the price rises on the confirmation candle, the reversal sign is invalidated, and the price could continue rising.
Following a price decline, the Dragonfly Doji shows that the sellers were present early in the period, but by the end of the session, buyers had pushed the price back to the open.
This indicates a high buying pressure during a downtrend and could signal a move to the upside.
The trend shift is confirmed if the candle following the Dragonfly Doji closes higher than the close of the Dragonfly Doji.
The stronger the rally on the day following the bullish Dragonfly, the more reliable the reversal is.
The Dragonfly Doji works best when used in conjunction with other technical indicators, especially since the candlestick pattern can be a sign of indecision as well as an outright reversal pattern.
A Dragonfly Doji with high volume is generally more reliable than one with low volume. Ideally, the confirmation candle also has a strong price move and high volume of trading.
That's it for today's course. Thanks so much for watching, and we'll see you in the next one.
And if you found the information useful, don't forget to subscribe and share this with your friends. Hello everyone, and welcome back to a new video brought to you by the InvestAbros Academy.
In today's video, we will discuss a term we have used quite often in our earlier videos called volume.
We will explain what this metric is and how it's calculated.
And also how you can use volume to improve your trading. So if this is what you want to learn more about, stay with us till the very end of the video.
If you missed one of our previous videos where we discussed several types of candlestick patterns, we recommend that you also watch them so you won't lose vital information.
If you like the video, don't forget to share, like and subscribe so we can reach out and teach more and more people.
And don't forget to hit the bell notification button so we'll be updated when we post a new video.
So what is this indicator called volume, or more specifically, volume of trade?
Volume of trade is represented by the total quantity of shares or contracts traded for a specific security.
It can be measured on any type of security traded during a trading day, like on stocks, bonds, option contracts, future contracts, commodities, and crypto.
Understanding the volume of trade.
As we said, volume of trade measures the total number of shares or contracts transacted for specified security during a specific period.
It includes the total number of shares transacted between a buyer and a seller during a transaction.
When securities are more actively traded, their trading volume is high.
And of course, when securities are less traded, their volume is low.
As a general behavior, volume tends to be highest near the market open and close, and at the start of the week and last day of the week.
One good example is the opening of the stock market in the US, which takes place every working day at 9:30 a.m. How volume of trade works.
Each market exchange tracks its trading volume and provides volume data.
The volume of trade numbers are reported as often as once an hour throughout each trading day.
These hourly reported trade volumes are estimates.
A trade volume reported at the end of the day is also an estimate. Final actual figures are reported the following day.
As a surrogate for trade volume, investors may also follow a security's tick volume, or the number of changes in a contract's price, since price tends to change more frequently with a higher volume of trade.
Volume tells investors about the market's activity and liquidity.
Higher trade volumes for security means higher liquidity, better order execution, and a more active market for connecting a buyer and a seller.
When investors feel hesitant about the direction of the stock market, futures trading volume tends to increase, which often causes options and futures on the specified security to be traded more actively.
Overall, volume tends to be higher near the market's opening and closing times, and on Mondays and Fridays. It tends to be lower at lunchtime and before a holiday.
Trading based on the volume of trade indicator.
Traders use various trading indicators in technical analysis.
Trade volume is one of the simplest technical indicators analyzed when considering market trades.
The trade volume during a large price increase or decrease is often important for traders, as high volumes with price changes can indicate specific trading catalysts.
High volumes associated with directional changes in the price of securities can also help to reinforce support for the value of that security.
Volume levels can also help traders decide on specified times for a transaction.
Traders follow the average daily trading volume of a security over the short and long-term periods when making a decision on trade timing.
Traders can also use several technical analysis indicators that incorporate volume.
Let's take an example of how the volume of trade is calculated, and let's assume that the market consists of only 2 traders.
Let us consider 3 companies from the non-alcoholic beverages industry: Coca-Cola, PepsiCo, and the Monster Beverage Corporation.
Let us assume that the first trader buys 100 shares of Coca-Cola and sells 50 shares of PepsiCo.
The second trader buys 100 and sells 50 shares of Monster to the first trader.
Thus, we see that the total volume of shares traded in the market on this particular day is 200. 100 of Coca-Cola, 50 of PepsiCo, and 50 of Monster.
This is because we don't double count the volume. When trader 1 buys 100 Coca-Cola shares from trader 2, only 100 shares are counted.
Likewise, only 50 shares of Pepsi and Monster would be recorded on the volume tally. The net impact of buying and selling on the respective shares on a particular trading day gives us the volume of this trade. Now let's discuss how we can use the volume indicator to improve your trading success rate.
Looking at volume patterns over time can help traders get a sense of the strength or conviction behind increases or decreases in specific stocks or even entire markets.
The same is true for options traders, as trading volume is an indicator of an option's current interest.
In fact, volume plays an important role in technical analysis and features quite often among some key technical indicators.
Let's look at some of the basic guidelines for using volume.
When analyzing volume, there are a few guidelines used to determine the strength or weakness of a move.
As traders, we are more inclined to join strong market moves and take no part in moves that show weakness.
Or we may even wait and watch for an entry in the opposite direction of a weak move.
These guidelines are not foolproof for all situations, but they offer general guidance for trading decisions.
Trend confirmation.
A rising market should see increasing volume, buyers requiring increasing numbers and enthusiasm in order to keep pushing the price higher.
Increasing price and decreasing volumes might suggest a lack of interest, and this is a warning of a potential price reversal.
This can be hard to wrap your mind around, but the simple fact is the price increase or decrease on little volume is not a strong signal.
A price drop or rise on a large volume is a much stronger signal in the market.
Exhaustion moves and volume.
In a rising or falling market, we can see exhaustion moves.
Participants who waited and are afraid of missing out on the move pile in at market tops, exhausting the number of buyers.
At the market bottom, falling price eventually forces out large number of traders, resulting in volatility and increased volumes.
These are generally sharp moves in price, combined with sharp increase of volume, which signal the potential end of a trend.
You will see a decrease in volume after the spike in these situations, but how volumes continue to play out in the next days, weeks, and months can be analyzed using the other volume guidelines.
Bullish signs.
Volume can be useful in identifying bullish signs.
Imagine a scenario where the volume increases on a price decline, and then the price moves higher, followed by a move lower back.
If the price on the move back lower doesn't fall below the previous low, and volume is diminished on the second decline, then this is usually interpreted as a bullish sign. Volume and price reversals.
After a long price move higher or lower, if the price begins to range with little price movement but heavy volume, this might indicate a reversal is underway.
And this means that the price of our asset will likely change direction.
Breakouts versus false breakouts.
On the initial breakout from a range or other chart patterns, a rising volume indicates strength in the move.
Little change in volume or declining volume on a breakout indicates a lack of interest and a higher probability of a false breakout.
So when you see a price breakout, pay a great deal of attention to the volume indicator. Low volume may mean a false breakout.
If the price breaks out and the volume indicator is not supporting this, avoid opening a buy position, as this can be a fake out and the price could reverse to the downside fast.
Be patient in these situations, wait for volume confirmation, and only then look at the possibility of opening a position in the direction of the breakout. Volume history.
Volume should be looked at relative to its recent history.
That means comparing the volume today to the volume 50 years ago might prove to be irrelevant data.
The more recent the data sets are, the more relevant the information is likely to be.
In conclusion, volume is a handy tool to study trends, and as you can see, there are many ways to use it.
Volume is often viewed as an indicator on liquidity, as stocks or markets with the most volume are the most liquid and considered the best for short-term trading.
Said simpler, there are many buyers and sellers ready to trade at various prices.
The basic guidelines we've mentioned previously can be used to assess market strength or weakness, as well as to check if volume is confirming a price move or signaling that a reversal might be at hand.
While volume is not a precise tool, entry and exit signals can be sometimes identified by looking at the price action correlated with volume.
And that's it for today's course. Thank you for staying with us so long. If you like the video, please don't forget to hit like and subscribe to our channel for more videos like this. Hello everyone and welcome back to a new video brought to you by the InvestorBros Academy.
In today's video, we will discuss a new trading indicator called the RSI, or Relative Strength Index.
We will discuss what the RSI is. We'll talk about bullish and bearish RSI swing rejections and how you can interpret them.
And we'll provide examples of how you can use the RSI to improve your trading quality. So if this is what you want to learn more about, stay with us until the very end of the video.
And if you missed one of our previous videos where we discussed candlestick patterns or the volume indicator, we recommend that you also watch them in the playlist linked below.
If you like the video, don't forget to share, like, and subscribe so we can reach out and teach more and more people.
And also, don't forget to hit the bell notification button so you'll know when we post a new video.
What is the Relative Strength Index?
The indicator was originally developed by J. Wells Wilder Jr. and introduced in his 1978 book, New Concepts in Technical Trading Systems.
Wilder gave traders a quantitative edge through research and the invention of new technical indicators that measured price movement and added a new dimension to price charts.
It's quite amazing to think that Wilder did all of this by hand in 1978 with no charting package, computer, or even without an Excel spreadsheet to use.
As we mentioned, one of the many indicators he came up with was the Relative Strength Index, or RSI, which is a momentum indicator used in technical analysis.
It measures the magnitude of recent price changes to evaluate if an asset is overbought or oversold.
The RSI is displayed as an oscillator, a line graph which moves between two extremes, with minimum value of 0 and maximum value of 100.
Traditional interpretation and usage of the RSI are that values of 70 or above indicate that an asset is becoming overbought or overvalued,
and that the asset may be primed for a trend reversal or corrective price pullback.
An RSI reading of 30 or below indicates an oversold or undervalued condition.
The calculation of the RSI indicator can be quite technical, and we won't review it in this video. But if you want to learn more about the calculation method, check out the article which covers this topic in full.
Interpretation of the RSI indicator. Generally, when the RSI surpasses the horizontal 30 reference level, it's a bullish sign. So, in your mind, you should start thinking about buying the asset.
And when it slides below the horizontal 70 reference level, it's a bearish sign. Similarly, in this scenario, you should start thinking of selling the asset.
And we know, selling in an uptrend when you see daily price increase is hard, but it's the best moment to do so.
A price correction will likely come, and, given patience, you will have time to re-enter the market at a more opportune moment.
During trends, the RSI readings may fall into a band of range. In an uptrend, the RSI tend to stay above 30 and should frequently hit 70.
During a downtrend, it's rare to see the RSI exceed 70, and the indicator frequently hits 30 or below.
These guidelines can help determine trend strength and spot potential reversals.
For example, if the RSI can't reach 70 on a number of consecutive price swings during an uptrend, but then drops below 30, the trend has weakened and could be reversing lower.
The opposite is true for a downtrend. If the downtrend is unable to reach 30 or below and then rallies about 70, that downtrend has weakened and could be reversing to the upside.
Trend lines and moving averages, two indicators we will cover in future videos, are helpful tools to include when using the RSI in this way.
Okay, but you may ask, how can I use the RSI indicator to my advantage? How can I improve my trading by using it?
To do this, let's look at an example and also introduce the concept of RSI divergences.
A bullish divergence occurs when the RSI creates an oversold reading followed by a higher low that matches corresponding lower lows in the price.
In simpler terms, the RSI indicator is in an uptrend, but at the same time the price is in a downtrend.
This indicates rising bullish momentum, and a break above oversold territory could be used to trigger a new long position.
A bearish divergence occurs when the RSI creates an overbought reading followed by a lower high that matches corresponding higher highs on the price.
Let's look at two situations where you can use the RSI to your advantage.
These are called RSI swing rejections.
These trading techniques examine the RSI's behavior when it's re-emerging from an overbought or oversold condition.
This next signal is called bullish swing rejection and has 4 parts.
Firstly, the RSI falls into the oversold territory.
Secondly, the RSI crosses back above 30.
Thirdly, the RSI forms another dip without crossing back into the oversold territory.
And lastly, the RSI then breaks its most recent high.
As you can see in the chart, the RSI indicator was oversold, broke up through the 30 level, was rejected to a higher low point, then broke through to a new higher value.
Use this to your advantage. An RSI evolution like this can indicate future bullish momentum, and it may be an opportune moment to open a long position or close your short positions.
A helpful tip is to draw trend lines on the RSI chart as you would draw on the price chart. Another example is the bearish version of the swing rejection that looks like the mirror image of a bullish version.
A bearish swing rejection also has 4 parts.
Firstly, the RSI rises into the overbought territory.
Secondly, the RSI crosses back below 70.
Thirdly, the RSI forms another high without crossing back into the overbought territory.
Lastly, the RSI then breaks its most recent low.
This scenario can indicate a bearish downtrend, so you may want to look for an opportune moment to sell your asset or open a short position.
As with most trading techniques, both signals will be more reliable when the longer-term trend confirms this. Remember, we spoke a lot about looking at the macro or high-level trend.
And this is applicable here especially. A bullish swing rejection in a general uptrend can be a strong buy indicator.
Similarly, a bearish swing rejection in a general downtrend can be a strong sell indicator.
If the overall trend does not confirm the short-term bullish or bearish rejection swings, be cautious, as the overall trend may quickly overcome the short-term indicators.
Limitations of the RSI.
The RSI compares bullish and bearish price momentum and displays the results in an oscillator that is usually placed beneath the chart.
Like most technical indicators, its signals are more reliable when they are confirmed by the longer-term trend.
True reversal signs are rare and can be difficult to separate from false alarms.
A false positive, for example, would be a bullish crossover followed by a sudden decline in the stock's price.
A false negative would be a situation where there's a bearish crossover, yet the stock's price suddenly goes up.
Since the indicator displays momentum, it can stay overbought or oversold for a long time when the asset has significant momentum in either direction.
Therefore, the RSI is most useful in an oscillating market where the asset price is alternated between bullish and bearish movements.
To conclude, the RSI provides traders with signals about bullish and bearish price momentum, and it's often plotted beneath the graph of the asset's price.
An asset is usually considered overbought when the RSI is above 70 and oversold when it's below 30.
Look at the RSI in conjunction with price evolution. Look at the high-level trend. Look for diverging RSIs to give you a buy or sell signal.
That's it for today. We hope you enjoyed the video and found the information useful.
Don't forget to share, leave a like, and subscribe to help us reach more and more people out there.
Bye! Hey there bros, and welcome back to a new video brought to you by the InvestaBros Academy.
In today's video, we will discuss a new trading indicator called moving averages.
We will discuss what moving averages are, what are the types of moving averages used, as well as how they are calculated.
If you missed one of our previous videos, where we discussed about volume and RSI indicators, we recommend that you also watch them, since these two indicators are used together in order to find good buy or sell positions.
If you like the video, don't forget to share, like, and subscribe so we can reach out and teach more and more people.
Also, don't forget to hit the bell notification button so you will know when we post a new video. What is a moving average?
When used in statistics, a moving average is a calculation used to analyze data points by creating averages of different subsets of the full data set.
Said in very simple terms, let's assume you have a series of numbers and you simply want to see what is the average of those numbers.
When used in finance, a moving average is a stock indicator that is commonly used in technical analysis.
The reason why we use moving averages in technical analysis is to calculate the average moving value of a stock.
And this is done in order to smooth out the price data by creating a constantly updated average price.
And also, by calculating the moving average, the impact of random, short-term fluctuations on the price of a stock over a specified time frame are mitigated.
Understanding moving averages. A moving average is a simple technical analysis tool.
Moving averages are usually calculated to identify the trend direction of a stock or to determine its support and resistance levels.
It's a trend following or lagging indicator because it's based off past stock prices.
Moving averages are calculated on different time frames. The most commonly used values are the 9, 21, 50, 100 and 200 days moving averages.
What is important to know is that the longer the time period for the moving average, the greater the lag.
So a 200-day moving average will have a much greater degree of lag than a 21-day moving average because it contains prices for the past 200 days.
The 50-day and 200-day moving averages are widely followed by investors and traders and are considered to be important trading signals.
The 50-day moving average is important because it's the first line of support in an uptrend or the first line of resistance in a downtrend.
The 200-day moving average is important because it represents approximately 1 year of historical data. These two averages can also give strong buy and sell signals when they cross each other.
Moving averages are a totally customizable indicator. This means that an investor can freely choose whatever time frame they want when calculating an average.
The shorter the time span used to create the average, the more sensitive it will be to price changes. The longer the time span, the less sensitive the average will be.
Investors may choose different time periods of varying lengths to calculate moving averages based on their objectives.
Shorter moving averages are typically used for short-term trading, while longer-term moving averages are more suited for long-term investors.
You're probably wondering what are the best or correct timeframes to use. Well, there is no one correct value to use when setting up your moving averages.
The best way to figure out which one works best for you is to experiment with a number of different time frames until you find one that best fits your strategy.
To predict trends in the stock market is no simple feat. While it's impossible to predict future movement of a specific stock, using technical analysis and research can help you make better decisions.
Said in simple terms, a rising moving average indicates that the asset is in an uptrend, while a declining moving average indicates that it's in a downtrend.
Upward momentum is confirmed with what we call a bullish crossover, which occurs when a short-term moving average crosses above a long-term moving average.
On the flip side, downward momentum is confirmed with a bearish crossover, which occurs when a short-term moving average crosses below a longer-term moving average.
As an example, when the 50-day moving average crosses above the 200-day moving average, we have the golden cross, which is normally a strong buy signal.
When the 50-day moving average crosses below the 200-day average, we have a death cross, which is an indicator of a potential upcoming sell-off.
While calculating moving averages is useful in its own right, this calculation also forms the basis of other technical analysis indicators, such as the moving average convergence divergence or MACD, a trading indicator that we will review in a future video.
Now, let's discuss the different types of moving averages, and we'll start with the simple moving average or SMA.
This is the simplest form of a moving average and is calculated by taking the arithmetic mean of a given set of values.
In other words, a set of number of prices in the case of financial instruments are added together and then divided by the number of prices in the set.
The simple formula is
where A is the average in the period N and N is the number of time periods. The second type of moving average is the exponential moving average or EMA.
The exponential moving average is a type of moving average that gives more weight to recent prices in an attempt to make it more responsive to more recent prices.
The formula to calculate the EMA is
where EMAT is the EMA today, VT is the value of the stock price today, EMAY is the EMA value of yesterday, S is the smoothing number, and D is the number of days.
As you can see, in order to calculate the EMA, you must first compute the simple moving average over a particular time period.
Next, you must calculate the multiplier for weighting the EMA, referred to as the smoothing factor, which typically follows the formula 2 divided by the select period plus 1.
So for a 21-day moving average, the multiplier will be 2 divided by 21 plus 1, equaling approximately 0.09.
Then you use the smoothing factor combined with the previous EMA to arrive at the current value.
It's a bit more technical, yes, and we don't really need to calculate the EMA by heart, especially considering that the trading platforms do this automatically for us.
But you do need to know that the EMA gives a higher weighting to recent prices, while the SMA assigns equal weighting to all values.
Simple moving average versus exponential moving average.
As we said, the calculation for the EMA puts more emphasis on recent data points. Because of this, the EMA is considered the weighted average calculation.
This means that the EMA responds quicker than the SMA to the changing prices.
Also, the EMA has a higher value than the SMA when the price is rising, and it falls faster than the SMA when the price is declining.
This responsiveness to price changes is the main reason why some traders prefer to use the EMA over the SMA.
Examples of a moving average. In our example, we look at how the SMA and the EMA are calculated for a data set of closing prices over the last 30 days of trading.
21 SMA would average out closing prices over the previous 21 days of data.
In this example, this would be 352, the sum of all closing prices divided by the number of days, 21 in this case.
This means that the first data point in the example is 16.8.
The next data point would drop the first closing price, 10 in our case, and would add the price on the 22nd day, which is 18, and redo the average.
In this case, the data point generated is 17.4. Then, a simple line is drawn between the 2 points to generate the moving average trend line.
This process is continued, and we obtain the following averages.
Now, let's look at the exponential moving average values for the same set of data.
The exponential moving averages are following the fluctuations in price closer due to the smoothing factor introduced by the formula.
Try plotting the 21 SMA and EMA on the price graph in your preferred trading platform and see how these fluctuate differently when the price changes.
In conclusion, a moving average is a stock indicator that is commonly used in technical analysis.
Moving averages of a stock are calculated to help smooth out the price data over a specified time period by creating a constantly updated average price.
A simple moving average is a calculation that takes the arithmetic mean of a given set of prices over the specific number of days in the past.
The exponential moving average is a weighted average that gives greater importance to the price of a stock on more recent days, making it an indicator that is more responsive to new information.
That's it for today's course. We hope you enjoyed the video and found the information useful.
Let us know in the comments below if you are using the SMA or EMA in your technical analysis, and if you are, what time frames are you using?
Hope you have a great trading day, and until the next time,
bye!